GM, everyone. Saturday, 31st of August. Weekend workshop number 5. I believe we're 5 weeks in already. Mad. That's so fucking good. I'm stealing that. Alright. So, how are we all? Good? Fantastic. Today is all about impulse candles. If you're new, welcome. GM, if this is your first stream, what a time to join. Today we're going to go over impulse candles. What is an impulse candle? You're going to find out. How can you measure them? You're also going to find out. How to trade them? You're going to find that out too. So, first of all, if you've not been here on Weekend Workshop, it's a bit different. In terms of asking questions, I don't take general questions today. This is a specific workshop. Weekends are a time to get ahead of the competition. The way you'll do that is by following the Weekend Workshop process, which is I do a lesson on a specific topic. As the lesson's going on, if you've got a question about that topic, you can drop it into live questions over here, which I will open up. So please ask questions, only questions that are related to the Weekend Workshop. If you ask anything else, I will not answer it. So please just ask questions that are related to it. And let's fucking go. I'm sure there'll be lots of questions. Many of you like the impulse candles. Let's fucking do it. Alright, so now give me 1 second. Some water now. Fucking bullshit. Alright. Okay. Let's do it. So first of all, I go through a mini lesson, and then I'll take your questions. If you have questions as they come in, drop it in there. Let's go. Rebecca, real footage of my dream. Fuck your father and that shit. Brilliant. Okay, let's do it. And not that it matters for you guys because you're here, but the recordings of Weekend Workshop stay up for 24 hours. It is a weekend thing. So, let's go. GM. So first of all, let's talk about what is an impulse candle. That'd be a good place to start, right? Well, in a really simple sense, an impulse candle is a larger than average candlestick on whatever time frame you're looking at. So it is something that has, at least by its implication, more significance than a regular candlestick. Now, you know I'm all about objectivity here in this campus, and the only way to trade is if you're objective. You have rules, you can define things clearly. You don't want to leave things up to discretion as much as you can avoid it, because that's going to lead to confusion. So if I just say an impulse candle is a bigger or stronger or more significant candle, you're like, well, what the fuck is that? Like, how do I define that? So, 3 ways, really 4, but 3 that matter to you and that you can use right away. These would be a wide range, high volume, and a body to wick ratio. So, I'll explain each of those. Wide range is literally the size of the candlestick. So as you can see over here on this example, this candlestick is significantly larger than the previous. And if you want to say previous, again, you can take, let's say, the last 10 candles or the last 20 candles. You want to make it objective, you choose. Let's say the last 10 candles, 10 candles before this, right? And of these previous 10 candles, the total range, top to bottom, how far does it travel? Like, how wide is it? And you can measure that. You get the measuring tool out. You can look at this one. From bottom to top, it's 3729. And so on and so on and so on. You can obviously just eyeball the rest and say that's less, right? And then you look at the candle that we're looking at here. This impulsive candle has a 4267 range. You can also use it in percentage terms if you want. From bottom to top, the entire candle, wick and body. And you can say, okay, based just on that, does this candle have a wide range, wider than the last 10 or wider than the average of the last 10? Yes. That's one way of doing it. Why 10? No reason. You can do 14 if you want. You can do 20. Completely up to you. But when you do this, and as you do it for a while, you will learn what works best for you. The main thing is that you're trying to find an objective way of saying, is this candle significantly bigger than the average? Now that also includes candles like this with the wick. Right? So this does not account for just how full the body is versus the wicks. This is just about the range. Range means extreme to extreme. So from the low to the high of the candle. How much of the price, like how much price does the candle cover? Just in raw terms, whether it's wick or body. That's one part. Second part is you want to have above average volume. Now, above average volume is very simple. You put on your volume indicator, which is the standard built-in volume indicator on TradingView, and you add a volume moving average. Its default is set to 20, so it will look back at the previous 20 candles and take a running average, which is the blue line you can see here. I'll make it thicker so you can see it more clearly. Right, maybe that's probably best there, yeah. And you can see that this candle, where I'm hovering over right now, has above average volume. So you could consider that as another check in the impulse candle box. Third, which is very important, is the body to wick ratio. So how much of the candlestick is constituted of a body, which is, the rectangular part, versus the wick, which is the thin parts on either end. That's where you look at something like this candle, which is almost the same range, right? This candle has almost the same range as this one, but the majority of the candle is actually wick, not body. What does that indicate? Well, that indicates two things. Number one, there was an excess, as the candle closed, there was an excess of supply or demand in one direction, meaning it originally went down, but by the time it was closing, the market was moving the other way. So if you're using this candle and saying, does this indicate the market might go lower? Your assumption would be no. Doesn't mean it can't go lower, but your assumption would be some demand is coming in. It's moving the market the other way. If you're looking at an impulse candle to insinuate continuation, which is the assumption you would have with it, you want to see a full body with minimal wicks. Again, you want to take that further yourself to measure it. You're talking about 70, 80, 90% of the candle, total candle, being constituted of a body. Good starting point would be 70%. If 70% or more of the entire candle is body and less than 30% is the wick, you could consider that to be a full body candle with a good body to wick ratio. Okay. Now you can take this further, and this is where your testing, your own back testing is something that you can employ. You could say, all right, well, when you say above average volume, how much? Right? Is it just anything above the average line? Or I'm going to narrow it down to candles that have twice the volume, right? So it's literally double of what the average is. Or is it 50%, 150%, right? So 1.5 times. Again, these are all things that you can do. And later on in the lesson, I'll show you an indicator I've made, which blue belts and above have access to. But it's important to understand this without any indicators, right? If you can't understand a concept without the indicator, then there's a gap in your knowledge. So I know everyone has seen the indicator. If you've read trading analysis and seen any of my videos, you'll know that there's these candlesticks that have the orange shaded in section when it's an impulse one. But it's very important to understand what goes into that. Now, why does all this matter? Well, if you've watched and seen the lessons, right, and if you've seen the lessons specifically on the nature of a trend, which is one of the core lessons in my campus, you'll know that the nature of a trend is that it has impulses followed by corrections. An impulse is how the price moves and generally should be the directional trend, and a correction should be in the opposite direction generally, but with a smaller range, lower volume, and all of that. Why does it matter? Because predominantly when you're using impulse candles, what you're trying to do is you're trying to find continuation, right? That's your assumption. You can use candles, impulse candles in different ways. But predominantly, the main thing you're trying to see is continuation. So, how does that look? An impulse looks like that, and then a correction, typical correction, will be back or sideways of some form in the other direction before price continues in the original trend direction. The impulse tells you, okay, this is more likely to go up. If you then see a corrective move, so it doesn't come all the way back down, it doesn't obviously go lower, it holds, the volume decreases because the impulse candle will have high volume, you'll see low volume here. That can be a clear sign that there's a strong move, it's consolidating and accepting, and it's going to continue moving. So you would find the impulse candle, you would wait for the correction, and you could trade the next leg. That could be one trading system you could use and test with that logic. So that's why all this matters. That's why it's also important to have each element of what an impulse candle is. You can see here, you have wide range, you have above average volume down there, and you have a good body to wick ratio. And that does equal continuation. And this actually shows two different types. In this example, the impulse candle leads to a short correction, but an upwards correction, and price continues higher. Obviously it goes lower later, but that's not important. The candle doesn't tell you what's going to happen 6 weeks from now or 6 hours from now, whatever time frame you're trading on. The candle tells you what to expect in the immediate term. And so this one, the impulse candle leads to basically immediate continuation. In this one, the impulse candle leads to a pullback, but the pullback is the opposite. Lower volume, lower range candles, smaller candles, and it pulls back into the impulse candle but not below it. So that's actually a successful retest, and then it goes higher. So, the third type, or not even the third type, the type you want to exclude if you're talking about continuation are these ones. Now, by far and away the biggest volume spike in all of this chart that you can see is this candle. But it doesn't meet the criteria for an impulse candle. So, if you were using the impulse candle measuring process, you'd see a wide range. Yeah, huge, biggest range on the whole screen. From top to bottom, no wider range exists. Above average volume, well above, probably 3 times the average volume. But body to wick ratio, nope. It's probably 50% or less of this whole candle is body. Therefore, whatever the preceding trend was, this was a downwards impulse, no doubt. This was a big red candle, no doubt. This was a high volume selling candle, no doubt. But, crucially, it closed with a longer wick. So, you didn't have all the elements you would need to say this should equal continuation. In fact, it equaled reversal. And price failed to go lower. One of the key signs that you could have spotted early for that would be that long wick. Right? So, the inherent assumption of an impulse candle is that it's going to lead to continuation. But it's important to remember that there are different types. So you have impulse that continues immediately, impulse that pulls back, and of course you have ones that do not meet the criteria. Next, I want to look at strong versus weak impulses, because of course if you've tested or traded or used impulse candles in your systems, you'll know that not all impulses are created equal, let's put it that way. Some of them have wider ranges, some of them have narrower ranges, some of them fail, some of them have good volume but then they don't go higher. So what really is a strong breakout and what is a weak breakout? First thing, it's important to consider the breakout point. I think this gets missed a lot because especially when you're on lower time frames, it's easy to see price breaking above a previous high or going below a previous low. And by the way, as with everything in markets, exactly what I'm describing applies on the downside and the upside. Right? A downwards impulse is the exact same as an upwards impulse. Just flip the direction. Right? You still want high volume. You still want a wide range. You still want a lot of body and very little wick if you're looking for continuation in that direction. So, using the daily chart, for example, the all-time high breakout is the most important, the most significant level that you could see. And so this example here from Feb 21, where you have a wide range candle, yes. You have above average volume, yes. See down here. And you have a body to wick ratio, which is in favor of a continuation. This leads to correction. This is an upwards correction. Important to remember as well. Correction just means the trend stops for a moment, so it doesn't continue impulsing, it doesn't continue strong trending. It starts to move into a consolidation, which is all a correction is. A correction is a consolidation. but this is upwards. Initially, it drops back, that's the correction, but then it goes into an upwards sloping consolidation, right? Because the market can only go two ways. It can trend or it can consolidate, right? So trend, as you know, is that. Consolidation, as you know, is this. But it doesn't just have to be that. Consolidation can also be this. It can be slightly rising. It can also be slightly falling. And it can be everything in between. That's one of the most important parts about impulse itself. Impulse is the way to filter through all the noise. Because when you see all of this, like let's say if you zoomed in and you just saw this week-long period, you'd say, okay, yes, it's going up. And imagine you had no knowledge of what happened before. You could just see this part. You'd say, yeah, it's going up, but it's kind of choppy and the breakouts are failing and there doesn't seem to be much volume and there's not much impulse. If you then looked backwards and you saw this, you would say, my bias should be for this to continue higher because we had all the elements of an impulsive breakout before, right? Then, on the very same screen, we have an example of a weak impulse, which is where we have an all-time high again, very significant level. We have a breakout, and by the way, this meets most of the criteria. It's got a strong, it's got a relatively wide range. It's got a decent body to wick ratio, but it's got low volume. There's one thing, right? It's got below average volume, which you can see down here. It has a, well, I mean, narrow range in comparison to the previous all-time high breakout. It has a narrow range. In comparison to the preceding rally higher, it's got a slightly wider range. But that doesn't matter anyway. You would have disqualified it based on the low volume. And, importantly, it retraces quickly. That's the part to look at. Whereas this one leads to price not pulling back. Within 2 days, this candle has taken us back below the breakout point. So you can say very clearly, this is a weak breakout attempt. It's important also to remember that that doesn't mean, and this is like the context, whether it's a 1 day chart or a 1 minute chart. The context of this is so important because this was a really clear sign of weakness. This is something that should have had you, if you're back then, this should have had you very concerned about the state of the current trend, which was obviously up for BTC. What it doesn't do is lead for the market to go straight down to zero, like people want it to. It actually comes back up and goes higher again and has another, by the way, weak breakout, another low impulse range, low impulse, relatively narrow range, but okay, low volume relative to the previous breakouts, and leads to further rejection, and then the market goes down. So it's really important to remember, when you have a failed breakout or a weak breakout, a weak impulse, it doesn't mean the market's going to just go straight down, even though it does initially go down, but it does lead to the higher time frame context of what is happening here. That was a clear sign of weakness that eventually led to the momentum fizzling out on the Bitcoin move and the top forming. And that is just as important to note on a low time frame as it is on a high time frame, like I said. You know, if you go in and look at, like, you can pick this out anytime you want. Like, just go to any time frame at any point and look at some of these moves and these attempts to break out, right? And we're looking at ones that actually do break out. Maybe it'll take a bit too long to find one because I haven't like prepared this before. But look in here, like there's a breakout and media continuation. Nah, it's probably going to take too long, but you get the idea, right? So what I described on the daily chart: strong versus weak impulses. Wide range above average volume leads to correction and good body to wick ratio, sign of strength. Narrow range below average volume retraces quickly. This is the easiest way to see it. When you see the narrow range or the below average volume, you should say, okay, I'm not buying this breakout because this is what we're talking, right? I'm not going to buy this breakout. I'm going to wait. Correction does not follow. It actually retraces. So it's not a bullish correction. It retraces fully. At that point, you know, fail breakout. Show this again. This is more of a, again, this is also on high time frame, but you can use it on any time frame. In the context of a bigger trend, or any kind of trend, you can also monitor the impulses as they develop. So here we're looking at the Axie Infinity from 2021, one of the biggest hype coins towards the end of the cycle. And we're looking at successive breakouts. These happen to be successive all-time high breakouts. So this is a good indicator of the macro trend. And you would have an early warning of trend exhaustion. You have a really strong impulse candle. You have the highest volume literally ever on Axie on this breakout. That leads to what? Correction, bullish, and continuation. So that was an excellent place to buy if you're looking for trend continuation. You then have an impulsive candle with much lower volume. And it leads to a corrective sideways move. It actually retraces all the way back, but the market still continues. There's clearly still some momentum left in this trend, but you can see this one is nowhere near as strong as the previous one. This led to a nice tight consolidation before immediate continuation. This led to more chop. It went higher, it went lower, but it held up. Then we had a big impulse candle breaking out, new all-time high again. A great, on the face of it, if you just looked at this from the context of recent volume, recent range, you'd say that's above average volume, yes. That's a wide range candle, yes. That's got a good body to wick ratio, yes. It's closed above the highs, all looks good, right? And in the near term, that does lead to some immediate continuation. But when you zoom out with the context, you can see a real weakening of the impulses because of the declining overall volume. A market that continues higher with lower volume is literally showing you, actively showing you, less participation. Lower volume means less trades are happening. If fewer trades are happening and a market keeps rising, it's only a matter of time before it reverses. This is particularly important on the upside, but it's just as relevant on the downside, right? Like I said, all of this, you invert it, it works for downside. But because crypto especially is such, and especially when you're in a bull market, and especially when you're looking out for the end of a bull market, crypto is such a long bias market. Everybody wants to catch the 100x. Everybody wants the big pump. Retail and fucking everyone, we're not here to short Bitcoin. We're not here to short crypto. Can you short? Absolutely. But the predominant reason to be spending all your time analyzing and looking at this market is so hopefully that you can avoid the down periods and capture the amazing 5x, 10x, 100x trends if you're lucky. Or just capture strong upside moves. Because we all know that when crypto runs, it really runs. So more than any other market in history, crypto really exists just for the long side. If you go back and you look at like commodities traders, for example, people who trade commodities trade. They're equally inclined to go long as they are to go short. No one cares. The average trader or institution or company, if they're not like a farmer, the average trader who's trading wheat futures doesn't give a single fuck if wheat goes up or down. They are no bias. They don't care. They're going to trade the long side and the short side. Same as crude oil. Same as fucking anything. Gold, slightly different. Gold has the gold bugs. There are people who are ideologically aligned with gold. That's why gold would tend to have more fanatical, participants. You see them all the time. They're just crypto people, except they're 40 years older. Just boomers. Instead of liking Bitcoin, they love gold. And they're worried about the fucking government shutting everything down and the debasement of the currency and fucking everything is doomsday. War's coming. Armageddon's coming. You need to stockpile gold. So you can look at each market and see how actively long the retail base is going to be. Right, something like commodities, very, very neutral. Traders equally willing to go long or short. Again, commodities excluding gold and maybe silver. You look at something like stocks. Again, most investors most investors in stocks are long only, right? If you're just buying, the index or you're buying single names to put into your portfolio, you're by definition generally long only. But in the trading community for stocks, there are much more of a balance towards long and short. Still skewed in favor of longs, probably still 70-30 of participants who want to just be long and they like Meta or they like Nvidia or they like Tesla, whatever. But you also have a healthy number of people who are willing to go both ways, short and long. But more so than commodities, stocks would be long only. More so than stocks, crypto is really long. We're talking 95, 96, 98, 90 fucking 9%. don't get confused by the fact that people talk about stuff in bears. Oh, it's going to zero, short Bitcoin to 40k, blah, blah, blah. That's just people who were long and bought the top and now they've got liquidated and they're just angry. They are not actually trying to short. Because anyone who's tried to, over time, right? Anyone who's tried to be bearish for crypto over the last 5 or 10 years is gone, dead, liquidated, done. Or they've turned into a bull. Because every few years, Bitcoin just smashes to new highs and goes way higher and flushes everybody out and proves everybody wrong. And then everyone's first, like if you're a wheat trader, your first experience of the market is not making loads of fucking money or hearing about your friend who made loads of money in wheat. You're going to come in with an idea already that you want to learn how to trade, and you learn how to trade through that. Maybe it's a bull market, maybe it's a bear market, doesn't matter. But almost everybody gets into crypto because they hear about their brother or their friend or their fucking granny who made loads of money on some Shiba monkey anus coin, and they want to get some of the action. So the default is always for crypto people to be long. So with that rant out of the way, this is really important for analyzing both high and low time frame trends. A market that is traded on attention, which is crypto. Crypto has a tendency to do nothing, do nothing, do nothing, do nothing, like we're seeing at the moment, right? The last 6 months. Nothing happens, it's dead, it's shit, it goes down, it bleeds, it's shit, it's dead, it's shit, it's shit, it's shit. And then all of a sudden, it goes insanely high and pumps like crazy. Attention drives every market, but especially crypto. Attention, if you're looking at it directly translated onto the charts, is volume and open interest, if you're looking at open interest on derivatives exchanges. If there is no volume, there is no participation. There can't be. People can talk on Twitter all they want about how bullish or bearish they are, but if there aren't actual trades taking place on the exchanges, nobody is fucking there. So when you're looking at that in terms of relative, there was relatively huge participation in Axie Infinity in July 2021. Then in August, there was less, but still enough to keep the trend going. Then in October, there was even less, really significantly less. And that eventually led to a weakening of the trend and the eventual top. Important to know, just because an impulse candle, this met all the criteria. Remember, if you're looking at the recent, which you should be, it's got a wide range, it's got a good body to wick ratio, it's got high above average volume. But then if you zoom out and said, well, actually, it's showing lower and lower volume in each push, which is true, you can say this is still a valid candle in the short term, so I'm not going to just short this, but it is a sign of a weakening trend. Then when you get some other price trigger later on, which would be something like price moving up, again, I mean, you've got endless here, fail to break out, break structure here, that's one, break structure again here at BOS, this too. By this point, December, which by the way, when you zoom out, not bad to get out of Axie there, was it? Even though it might have felt late at the time. You're like, okay, we've all the makings here of a completed trend. It's over. It's done. So, that is more, that's a little bit about how to just view it from an unbiased perspective and using the volume, using the impulse candles to understand better participation. Because that's what it is. Participation in the market. And you can play this off of people's emotions. The higher a market goes, the more that crypto retail, exit liquidity types will want to buy it. And if you see that buying is getting progressively weaker and weaker and weaker, it's not the smart guys buying at that point. Anything that's left must just be people who are FOMOing in. And again, that's just as valid on a 1 hour chart as it is on a 1 day chart. But the trends and the impulses and all of that are obviously cleaner the higher time frame you go. A little side note at this point as well. You might notice if you look at impulses or if you look at the impulse candle indicator, you'll notice that there are a lot more failed breakouts or failed impulses on a 1 hour chart than a 1 day chart. This is really simple. It should not confuse you at all. It takes far less to move the market on a 1 hour basis than it does on a 1 day basis. That's why a breakout with volume and wide range and good candle to body to wick ratio, that's why it's more impactful on a daily chart, because it takes more energy to do that. You're talking millions, if not tens of millions, if not hundreds of millions, if not billions of dollars of volume, depending on the asset. If it's Bitcoin, these candles would have billions of dollars of volume on a daily. So that's billions of dollars worth of participation. if that happens and it holds and it closes and it stays there, that's showing you that a far greater proportion of the market was all on one side, or at least agreeing that the market's going to go in one direction. That's more impactful. If it happens on a 1 hour chart, well, for Bitcoin or any coin, just divide it by 24. Instead of a billion, it might be 50 million of volume in that one candle, maybe 30 million. That's nowhere near as impactful. That's nowhere near as relevant. So yes, that can equal a continuation on that time frame at that point, but it wouldn't take much for that candle to fail. Instead of being everybody in the market, right, all getting in at the same time, and they're not all in the same direction, by the way, but the supply demand pushing in one direction, such as up, it could be just one participant or a group of participants or a small number or some news announcement. That's another thing, right? Some shitty project puts out a shitty announcement. There's a sudden burst of algo buying and retail FOMO. Those can fail a lot easier. Right? Just adding that little bit of context is important. Now, impulsive behavior. So, regardless of direction, the way you want to look at impulse candles is in a number of different ways. So, this is not including impulse candles that fail. I hope it's pretty obvious at this point that if an impulse candle fails, right, the way to tell it fails is when it goes back below where the impulse candle opened. That's a failure. Coming back to the point of impulse is actually not a failure. That can happen, and one of the examples I show here, that can also happen. It might be a sign of weakness in general. Maybe this trend doesn't go as far, but failure is when it retraces the entire candle and closes below it. It's important. That's the only way to define a failure. Okay? Now, 3 types. The one you all want, immediate continuation. Impulse candle breaks out, just buy the shit here and boom, away it goes. Fucking easy money, let's go. Doesn't happen that often, but can happen. Retest and hold, it's like what I showed a second ago. You have an impulse candle, it doesn't just go straight down, so this is a bearish impulse. Impulse candle, it comes up, it retests, but it holds, right? And then it goes in the direction of the impulse trend. Then you have the third type, which is very common as well, and probably the one that you'll see the most, which is the impulse candle leads to some type of consolidation, whether it's up, down, sideways, doesn't matter, leads to consolidation and then a continuation. This is your classic impulse correction impulse. That is textbook 101, how trends happen. Again, impulse behavior for a failed impulse candle, very simple. I'll show those in a second with the indicator, but it's just one that has an impulse and it retraces. And by the way, we're talking impulse here. We're talking impulse breakout is where you should really employ it, right? It should be in the context of your previous trend. So you're looking at a BOS, so it has to break above, or a BOS where it breaks below, or a significant range breakout, like an all-time high breakout, whatever. When you're just looking in a range, right, when you're just looking here, like this can be an impulse candle. But should you use that or apply any logic about how to trade that, right? That's got above average volume. Let's just imagine. It does. I know this. I remember this candle, right? This has above average volume, right? It has just enough of the body to wick ratio. That's fine. And it has a wide range. But it's not in the context of anything significant, right? It doesn't break structure, so this is a downtrend. It doesn't have a market structure break. It doesn't go below the low, so it doesn't lead to continuation to the downside. So an impulse candle that happens basically in the middle of nowhere, don't expect it to do much. The ones you should be looking at are stuff like this, right? Where you have market rising, it's setting a high. Let me use the candle close just to be exact here. Right, you've market rising, it moves up, it consolidates, it breaks out above the BOS, like here, and above the previous high, and closes strong. Those are the most significant candles that you see, right? There has to be the logic or context about a breakout. Because an impulse is fine, but if you just look for every single impulse on the chart, you're going to find loads of them. But if it's not within an area where it could lead to a trend in one direction or the other, don't use it unless you're going to use it the way I described later, which could be a failure, which is completely valid. But again, this is where you have to think about price behavior. Okay? An impulse candle that happens in the context of a trend, where you have a swing level and it breaks out, you would expect continuation. If the impulse candle just happens, inside of a range like this, and you see an impulse candle like that, but it doesn't do anything significant, they're more likely to just fail. Because price is not breaking out, it's not breaking down, it's just within a context of a range. So you could actually apply the opposite logic and use it as a failure point. But again, I'll cover that in a sec. So, price action context. Is that the next one? Impulse behavior. Yes, it is. Okay. Now, which fucking time frame should I be on here? Oh, wait, no. Here we go. All right. So many screens. So little time. Next, the context of price action. This is especially important for low time frames. A question I get all the time is, you've gone through the lessons, you've learned about market structure, and you've learned about BOS in particular. And you notice this, I'm sure you all have seen this, where the market's going up, and it is technically making BOSs, but it's not showing any volume, any momentum, and you're like, it's just sort of, the word I always use is grinding. It's just like it's grinding higher slowly, or it's grinding lower slowly. Impulse candles are your perfect tool for these. What you're looking for is an impulse to give you a clear sign. It's really tempting, and this is what gets so many people chopped up and caught out and losing money. It is exactly what this move here is. In fact, if I can just pause and zoom in here for a second. Exactly what caused this reversal is this. If you look at this, you can see, there's only single candles in between, but you can see BOS, right? BOS, BOS. These are all technically breaks of structure. This market is technically going higher. And when it's happening, it's really easy to fall into that mindset of, oh look, it won't go down. Must be strong. Like, it won't pull back. It won't pull back. It won't, until the first attempt at a breakout, when any volume comes in, what happens? It reverses and smashes everybody to pieces. Because a low volume, choppy, grinding, shitty market, don't trade it. You need to wait for an impulse that gives you confirmation of a trend direction, and then trade that, right? So, how do you do that with impulse candles? You apply the context of price action. So I show here some of these different levels. Anything I've marked with a green dashed line, dotted line, here, fuck you, here, right? If there's a green dotted line, this is a BOS that you would trade, or you would see as significant. Why? Well, price grinds up and grinds up and grinds up, and then it breaks out with an impulsive candle, high volume, and it closes. So that BOS has impulse is good. What happens? It goes into a corrective phase, and then it has another impulse higher. And that impulse, where the green arrow is a strong, high volume, wide range, body to wick ratio, tick, 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 holds, consolidates, goes higher, consolidates, another impulse, another breakout, high volume, good body to wick ratio, equal continuation, continues, so on and so on. Right? So any of the ones that have green arrows and green dotted lines are showing the impulse parts. But what you see when you're actually monitoring this as it goes is you're seeing stuff like this. This dotted black line, that was a BOS as well, right? And this is what confused people. It's like, well, isn't this technically continuation? Right? It goes higher. It closes above. Should I buy that? The answer is obviously no. And this is where you're looking at like the rule, the strict rule of market structure. Is this a BOS? Yes. If you're using candle closes, it closes above the previous swing high. That is technically a BOS. If it closes above here, again, that is technically a BOS. But what you'll notice and what you'll know from doing your testing is if you buy those, quite often something like this happens. Where you buy it and it goes sideways and then it drops back. Oh, that dropped there, and it takes out, it stops and takes out all this. Why? Because again, this is not trending. This is after an impulse, you have the correction or the consolidation, which does not have to go like that and then straight up. That'd be nice. But it can go like this, and it can drop back, and then it can go up. Remember, your impulse was telling you the probable trend direction is up. But this shit in between, you have to differentiate it between trending and correction or consolidation, which is the same thing. This is going higher. It is making BOSs. But remember the context. It's in a consolidation after an impulsive move. Then you get the next impulsive move. That gives you your clear sign. This market still wants to rise. And all the stuff that comes after it has a BOS, it has a BOS, it has a BOS, then it drops back. Then your impulse comes in. So, how do you trade this? You use the context of the impulse candles to frame a trend direction. So, after that impulse candle here, you should be looking at entering on the consolidation based on whatever system it is. It might be an attempt to go lower that reverses on a lower time frame. That's up to you. I can't build your systems for you. I'm just teaching you the impulse itself as the trend direction. And why does this really matter? It matters because a lot of times people will they'll see this BOS here and they'll buy and they'll put their stop loss below the impulse candle or below the new market structure level, right? And then they'll get stopped out. If you're looking at a trend, the market structure level that matters the most is the impulse. So you could use the impulse for your invalidation on the trade. You'll notice that this impulse candle did not get revisited on the way back. So even as the market dipped down before its next move, it did not go back below the impulse candle because that was a valid impulse. That meant it was more significant than any of this shit that happens in between. And you could use that as your trend invalidation. Then you get another impulse and you can say, okay, use the impulse for your invalidation. There's your trend invalidation again. And you can move it up as you go. And what you don't do is you don't move your stop loss to here because there's a breakout or a break of structure at this level. There is a BOS, but that's not a strong low. That's not a significant low. The impulse candle is your significant level. The next time you have an impulse candle, that's your significant level. The next time you have an impulse candle, that's your significant level. And so on and so on and so on until it fails. And it obviously will fail. Every trend is doomed to fail eventually. Nothing can trend forever. But taking this will allow you to filter through some of the noise of these sort of grinding, choppy parts where it looks like it's going higher, and yes it is. It looks like it's going lower, and yes it is. But don't forget, a correction can go down, a correction can go up. It's the impulses, generally, the impulses that give the overall higher time frame direction to whatever trend you're trading. If there's a trend at all, by the way, which is also very, very important to note at this point. As I take a drink. Markets don't trend by default. Alright, so by default, markets will spend most of their time not trending. Trends require much more participation, much more consensus, and generally a catalyst. So for the market to keep rising, people have to not want to sell, and they have to want to buy. So why would people not want to sell? Well, there must be some new reason or a pre-existing reason that is still strong that makes them not want to sell. And usually this is something that doesn't exist. Once you have a move up or a move down, it will start to go sideways. 20-80, like 80-20 is a rough guide of this. 80% of the time the market is just going to go sideways in some form. 20% of the time it's going to go up or down. That's very rough, but it's meant to highlight the idea that whether it's on a 1 minute chart intraday or whether it's on a 1 day chart, most of the time the market will not actually be in a strong uptrend or a strong downtrend. Because the conditions that need to be present for a trend to happen require something known as cause and effect. This is part of the Wyckoff lessons, law number 2, effort versus result. Cause and effect. For a market to rise, there has to be a reason, an underlying cause that's built. That can be purely technical, it just can be accumulation by strong hands or distribution by strong hands. It can also be catalyst driven by some new piece of news, some update, some upgrade that's coming, some significant political event, some Fed actions, whatever. But generally, when the market's waiting for this next bit of news or this next catalyst or this next big buyer to come in or big seller to come in, it's going to go sideways rather than up or down. And like I said before, the default mode for coins in crypto is down, not up. If there is not participation, the market will not go sideways until there is participation. It will go down. Let me just take another pause here to rant for a second. Pick any fucking coin, right? People talk about this last, if you look at Bitcoin, people talk about this last 6 months as being quiet summer period. Right? If you just look at Bitcoin, you're like, all right, Bitcoin's down. Yeah, it is down. It's down. It's down 20% off the highs. But broadly, this is not like super painful. If you bought Bitcoin anywhere this year, you're probably still in profit. If you bought, late last year into this year, you're probably still in profit. You may be at break even. Maybe you bought the top, you're in a little bit of pain. But most people, when you see them online, they're like, oh, everyone's so bearish. Everyone's so bearish, even though the market's just dead. It's just quiet. It's just a quiet summer period. Just get through the summer period, bro. Then it's all good again. But that's not true, because most people don't own Bitcoin. They own XYZ, insert any fucking altcoin here. And so no, summer has not just been, and by the way, when we talk about summer, I should actually draw from June, because people are talking about summer. They'll look at this, and they'll go from the 1st of June, and they'll look here. Bro, Bitcoin's only down 12%, and it's basically sideways. It's basically consolidating. But that's not true. Go to any other coin from the 1st of June, and you'll see why everybody online is so fucking, seemingly bearish. But they're not bearish for no reason. Just ARB itself is down 54%, and that is insert any altcoin. So no, this is not just a quiet summer period. This is a 50% haircut on your net worth if you're holding ARB. So why do I say that? Because not directly about impulse candles, but in the same logic of what I talked about before. If crypto does not have high participation, which I was showing with the Axie Infinity chart with volume, if crypto doesn't have high participation, it will tend to go lower. It has to, because attention drives the market. If there isn't attention, the market's not going to move. If the market doesn't move, it's not going to go sideways. This will not go sideways until it's ready to go up. It will go down. It will drift lower until it's ready to go up. Now, of course, eventually it will stop, and this is what you're looking for as a trader. You will look for it to stop going down, because it's just been down, down, down. If you notice that it stops going down and starts to go up slightly, you're, oh wait, are we back? Well, we could be. Just like here, it's going to drift lower and drift lower and drift lower and drift lower until it doesn't, and then away we go. So, just a side note there. Next. So I've covered impulsive behavior. I've covered the context of price action, which is especially relevant on lower time frames. Now, I want to look at how to actually trade the impulses, but from the opposite side, in terms of failure and correction. So you've seen an impulse, and this is sort of like slightly counterintuitive logic, but it's not really, because even though an impulse candle is like the best candle you could get, right? If you're trying to objectively measure a candle and say, okay, if we're in an uptrend and I want the uptrend to keep going, what kind of candle do I want to see? You want to see an impulse candle, which means instead of seeing a breakout candle with low volume and a breakout candle with a narrow range, you want to see a breakout candle with high volume and a wide range. Cool. But even that doesn't mean that it's going to continue to go higher. Like I showed a moment ago, it can pull back first. So impulse does not lead. Where's the behavior one? Where the fuck it is? So many charts. So little time. I don't know where the fuck I put it. I think it's this one, right? No. It is. GM. Right? Impulse might lead to immediate continuation. Impulse might lead to a retest. And impulse will probably lead to consolidation and continuation. Now, this is the one you want to look at. These two. If it retests and holds, what's going to happen first? This impulse candle is going to fill back in. So you can actually trade it in the opposite direction. Even here, the impulse candle is going to fill back in part of it. And this is where you can apply some really simple contrarian logic, right? Because when somebody sees the breakout, they think, let's fucking go, it's going to go up. But how often have you seen this? How often have you seen a big breakout and you think, fuck, I need to buy, and then you buy, and then it goes down. And then it goes down and you sell, but then it goes up again. That's literally what happened over the past few weeks. That's what this is. This massive candle made so many people FOMO back in. I have to get long, I need to buy. Are we buying? Are we getting back in? Or what are we doing? Right? And so many people bought. And what happened? It actually did not get bearish, and still isn't bearish, by the way. It hasn't gone below the impulse candle. What did it do, though? It pulled back. And so the correct trade, or the correct way to approach this, was to expect that this would fill back in. And actually, if you traded short within that week or two period, you had the right direction. Now, it did end up going higher, and it did build up, and it did break out. But again, just because an impulse happens doesn't mean that it's going to go straight up to the moon or straight down to zero. That's one way, impulse with immediate continuation. But especially when it's a green candle, you're much more likely to see some consolidation that follows. Because, as I said before, this is not wheat. This is fucking crypto. This is the most cult-driven, religious, fanatical type of holders in history. Everyone's just, I want the fucking best. I would need the 100x. I need it. I need to get me and my family out of poverty. And everyone's desperate. And desperation creates bad decisions. And the bad decisions are almost always buying, not selling. This is another thing. This is another fucking rant. The reason why impulses, if you're looking at impulse candles to the upside, the reason why they fail more often, and when I say fail, you can consider this as a failed immediate continuation. It's not a failed candle overall, but anyone who bought this candle probably sold here, and then had to watch as it broke out here, and then they bought again, and then it fucking wrecked them. And that's why everyone's so fucking spun up in circles, right? Because they're literally just exactly, like, if they could just change their behavior 180 degrees, just do the exact opposite, they would have a better chance of being successful. Because your kind of monkey brain logic, when you come in and you don't manage risk, and you don't trade systematically, and you don't have a plan, and you don't analyze, and you don't journal, you don't do all the things I say to do, when you just come in, you want to buy big green candle, you want to sell big red candle. But people don't sell the big red candle. This is important. What you'll notice is, whenever you have red candles, they tend to actually get followed up by more red candles in a row. Why is that? You know this yourself. So, if you're holding crypto, think back to the 29th of July, right? Big red candle. Big red candle, big red candle. You probably didn't think about selling on any of these. Big red candle. You're probably like, fuck, that's not good. Probably I should sell. But you hesitate. And then you don't sell, and you don't sell, and then eventually you sell at the bottom. Why does that happen? Because when it comes to selling your crypto or closing your long, you have to accept that fucking Lambo might be out of reach. That 100x massive trade that you were expecting might be out of reach. You have to passes the logic test. People are more likely to FOMO into a long than they are into a short. Okay? Simple. I've explained this. You can take exactly of pullback, and yet the one manage risk, and you don't trade systematically, and you don't have a plan, and you don't analyze. Fuck, that's not good.